Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. Well, as we went through the back end of 2018, and especially in Q4, people were very much focused on the high volatility we saw in the S&P, the Nasdaq, and of course global equity markets and credit markets. And we're seeing signs of that spilling over into 2019, where we've still got the VIX above 20%. And it's our base case that we're going to see these pockets, these elevated pockets of high volatility in equity markets being a consistent thematic throughout 2019. But the question, of course, now is are we going to see higher realised and higher implied volatility in G10 FX markets? We can focus very much on euro-dollar, obviously the most traded currency pair out there, and see that volatility in this pair is just absolutely shot to pieces at the moment. If you have a look at the 10-day average true range in euro-dollar, it's around 57 points, which is about as low as we've seen since July 2017. You can effectively see euro-dollar holding a 113 or 114 handle at some stage on an intraday basis for the last 51 trading sessions. We've got to basically go back to 2018 into that May to August period to see a situation where it held those dynamics, sort of 116, 117 handle at some stage during the intraday period for 58 trading sessions, which is actually the longest run on those sort of dynamics since the inception of the euro in the late 90s. So we are getting to a very extended run where the market's just really shied away from pushing price away from this sort of fair value level that the market seems to be implying at the moment, given the sort of fundamentals that we have in play. But it's not just this pair. I mean, implied volatility across G10 is very low, perhaps outside of sterling, but we obviously know what's been happening with Brexit and the dynamics that are unfolding there. But that's a function that we are seeing a global synchronized slowdown playing through. Most central banks have acknowledged that downside risks. Rate hikes have been priced out of the interest rate curves, and we are in a situation where it's, a lot of people are data dependent and waiting for the shoe to drop. So this dynamic where pretty much every central bank is in a kind of wait and see mode amongst this sort of global slowdown has seen volatility suppressed. What we want to be seeing for higher volatility is we want to see yield spreads widen. We need to be seeing currencies follow that, and what that means is we need to see economic divergence and we need to see central bank divergence. Effectively, on a very simplistic level, we need one central bank to say we're raising rates and we need a central bank to say we're cutting rates, and we see this dynamic of central bank divergence playing through. At the moment, we've got synchronicity where pretty much every central bank is in a wait and hold situation, and that's really suppressed volatility in G10. So what's going to cause a pickup in volatility? Well, it's going to be central bank divergence. Are we going to see that? Perhaps. Well, we need to see signs of economic trends changing, and at the moment all the economic trends are that we are seeing deterioration. Of course, we've seen the IMF and various bodies talking about downgrading their growth forecasts, and of course they're sort of late to the party. Most people have been downgrading their forecasts, but we're going to need to see those changes in trends. Now, euro-dollar is the one that we're very much focused on because obviously it is the most traded currency pair out there. In fact, euro itself has actually had some big moves this year, but specifically against emerging market currencies, where we've seen the euro hit pretty hard against things like the ruble, against things like the Mexican peso, the Brazilian real, those sort of high beta emerging market currencies. Even euro Aussie's had a reasonable fall this year, but euro dollar throughout this year is pretty much unchanged, and everyone's been looking to fade it into 115. People have been looking to buy it back into sort of that low 112 situation. But I think once it does break, there is going to be a longer term trend playing through, and I think once that does break, you need to respect that. It's going to trend quite beautifully, in my opinion. The debate, of course, is which way is it going to break. The short-term trade, which I'm looking at more closely, is what's happening in Euro Swiss. I think once we get a break of this horizontal resistance level you can see on the daily chart level here, I think that's the cue. Then you're going to see Euro Swiss trade higher, and I think that's probably the trade du jour for me at the moment. But certainly looking at euro dollar, what's going to cause us to break out of this malaise that we've been seeing? If you do run an EA that likes range trading, then continue to do so in the short term, in my opinion. But I think we focus very much on Mario Draghi tonight. He steps up, and the statement will be coming out at 11:45. Mario Draghi will step up shortly afterwards with his commentary. And there is no one better at suppressing volatility than Mario Draghi. He does it better than anyone else in the world, and he's been the master of causing the euro to weaken. He's been the master of promoting positive upside in European stocks and the DAX and whatnot. So we will be keeping an eye on that. But is this the time to meet the market? And I think that's the question we're seeing at the moment. So this deterioration we've been seeing in economic data in Europe, you've seen the market really toying with the idea that Germany could be going into a technical recession. Italy probably already there. You've seen we haven't seen the full fallout from the yellow vest movement in France yet, and that's something that we will be watching. And the European and the ECB's own targets for GDP this year at 1.7% obviously look way too optimistic optimistic. We're expecting that to be closer towards 1.2, 1.3%. Its expectations for core CPI for this year at 1.4%, again, just look a little bit too high. And again, at some stage, they're going to need to downgrade that. If you have a look at the rates market, they're pricing in 6 basis points of tightening between March of this year and December of this year, and that's come down quite radically over the last few weeks in line with the deterioration we've been seeing in data. But there are signs now that European data has bottomed, and if we do start seeing it pop up, then things could be less bad. And I think most economists out there are of the view that the ECB will be raising rates in October. Now, the ECB's own guidance is that they will look to raise rates at the back end of the summer of 2019. I'm not so sure that that's the case. I think at some stage they will have to say that rates are going up at the end of 2019. Whether that comes at this meeting or whether they give a pretty clear indication that it's going to come at this meeting is yet to be seen. I suspect, if anything, they're going to give an indication that they may change that, but they probably won't change that forward guidance at this meeting. It probably comes in the next couple of meetings. The other point that we need to focus on is whether or not they're going to give a very strong indication about new refinancing operations, what they call the LTROs, where the banks, the commercial banks, so the investment banks in Europe can get very, very cheap liquidity to the ECB's balance sheet and effectively get very, very cheap liquidity and loans, which they can use to pay back previous loans throughout the last few years, or they can actually put that money to work to improve their margins, either by lending and put it into risk assets. And again, the market seems to like that extra liquidity that we could be seeing playing through there. Well, that in theory could be a euro negative, but we'll have to see how that plays out and what people suggest. But of course, we're going to be watching out for this meeting to understand what is the appetite for them to put out a new LTRO and effectively cheap liquidity. So the dynamic we are watching in Europe is how confident are the central bank in Europe about a potential economic reversal. At this stage, I think we're probably most likely to see Mario Draghi acknowledge that the weakness is transitory and they expect to see better days ahead, and that could be a euro positive. And if we then subsequently start seeing a better trend in European data, the market will respond, and I think we'll start to see capital savings flowing out of Europe back into the Europe. And I think if you're looking for a resolution for this range trade, then I think euro dollar breaks out to the upside in that situation. But that's a big if, and the trend in that data is still very much down. But if we do see signs that it's basing and actually reverses, then I think euro dollar trades higher. I think there's still more to play out in the US. So that's really the base case for me, is what happens at this meeting. At this meeting specifically, the options market's pricing about 60-point moves. They're not expecting fireworks, which tells me that the base case of the market is that he will acknowledge the downside in growth, but still remain of the view that the next move in rates will be at the end of the summer, but open the door for policy flexibility in this situation, and flexibility about their growth and inflation forecasts as well. But the key debate is what will cause higher volatility in G10 FX, and it has to come from changes in economic trends. At the moment, there's synchronicity between the slowdown. That needs to change, and we will see a higher volatility and better trending conditions. And this idea about the suppressed volatility in euro dollar has to change because of what's happened between central bank divergence and the idea that at some stage towards the back end of the year, the ECB will actually have ammunition to raise rates. At the moment, I can't see that happening, but if the data starts improving, then we will see it, and we will see an upside resolution break in the euro dollar. But that's the key talking point at the moment. Volatility is so suppressed in euro dollar. What's going to change that? It has to come through economic changes and divergence playing through at a central bank level. So we'll be watching and waiting and seeing exactly what Mario Draghi says there.